Hey, whoa, everybody. A lot of stuff to talk about today. A lot of stuff. But first, let's get the important thing out of the way. It is Monday, February 24th. I sent out the new edition of MMT Trader. So if you want to get a copy of that, and you definitely should, because there's a lot of stuff that I talk about in there related to what's going on. Go to my website, pitbulleconomics.com, and sign up for a 30-day free trial for MMT Trader. Remember, I'm the only one who has an applied approach to MMT. I take the concepts and understandings of MMT and I use them to trade and invest in the markets. Nobody else does that. There's a lot of MMT academics out there. They talk about MMT, they write about MMT. Nobody has a way where they have synthesized the MMT understandings and used them to invest. All right, so that being said, down 1,000, over 1,000 points today, over 3.5% down on the S&P. Big rout today. And by the way, last week I was away. I was out in Arizona, but I was active. All my subscribers were getting my emails and my updates. I didn't have time to make any videos. On that note, let's talk about a couple of things. All right. First of all, coronavirus. That's in the news. It is spreading. We've had a number of firms, including Apple, very important firm, at least for the market, issuing cautionary guidance, lowering their guidance. Nike was another one. A bunch of companies now, a growing list of companies issuing guidance and talking about how the virus is affecting their operations, possibly their profits going forward. So that has been negative. But that's been coming out. That didn't all just happen today. Now, I have a theory about today's decline, which I'll get into. And it may just be the corona. Look, we don't know. We know that it's spreading. All right, there's something like 70 or 80,000 cases reported in China. Over 2,000 people have died. It's in Italy now. Right? They canceled their festival there. So it's in South Korea, it's in Japan. All right, so it is definitely spreading, and we do not know the extent of the economic impact, but it looks to be getting worse, at least from firms we're hearing. I'll tell you this, just some anecdotal evidence on my part. I flew through Dallas-Fort Worth. The airport was empty. The airport was dead. And I was there at a reasonable hour. I think it was like 11:30 a.m. on last Tuesday. And I flew back on Friday, again around 11, 12 noon. Airport was dead, Dallas-Fort Worth. Now, I fly through there a lot, and it's never been like that. I mean, it's usually teeming with people. There's people everywhere. That was not the case. So I don't know, maybe you have your own anecdotal evidence that you've said. The planes themselves were packed. They were full. So I don't know. But the airport, man, that was empty. I was shocked. In fact, I took videos of it, and I was really surprised. Let me talk about the fiscal situation. You know, if you've been following me for the last month, you know that my position, my outlook on the market has changed. I mean, whereas I was bullish for the last 4 years, basically, and last year particularly, buying every single dip. Also back in December 2018, when we had that big market correction, I was pounding the table, telling people to buy. And the reason behind that, you should know by now, was that the fiscal support, this is what I follow as an MMT adherent, that was very strong. And recently I've been telling you that, you know, when you look at the fiscal flows, that means the spending flows, putting that income into the economy, and the tax flows, taking the income out of the economy, those things are starting to narrow, okay? In fact, the growth rate of the tax flows, taking out that income, exceeds the growth rate of the spending flows. And I mean, the easiest way to look at that, or I guess if you want to take a little snapshot of what that looks like right now, you look at the deficit. The deficit is 454 billion right now, and I see that number every single day. I don't have to wait a month because I know how to take it off of the daily treasury statement. Now, 454 billion may seem like a lot. However, that's only 8.6 billion above where it was last time, at this time last year. Only 8.6 billion. What does that mean? It means only a net addition of 8.6 billion of new financial assets added to the economy. That's tiny, man. Now, to give you some perspective, last year at this time, the increase in the deficit over the previous year was 136 billion. So last year at this time, the economy had already received an injection of 136 billion new financial assets. Okay, that's wealth. That's wealth. Now, why is that a problem? This year's only 8.6 billion. Because last year's 136 billion, right? That was only good enough to drive a 2% GDP growth rate. So this year you've had very little, minute increase in that addition of wealth. You can't expect much then. You can't expect much. And this comes against a backdrop of the stocks being highly overvalued, hitting record after record after record. Remember the beginning of the year? All of these Wall Street guys who were bearish for so long at the beginning, don't sell stocks. Now would be the worst possible time to take profits. Buy, buy, buy. And I said, you got to be cautious. You got to be cautious. And we were looking at the AAII sentiment survey. We were looking at the put-call ratio. I've been talking about that. All right, anyway, here's another thing to ponder, okay? And at first I thought this was my own idea, but in this case I'm happy to see that others are starting to catch on to this or kind of, postulate that this could be it. I'm calling it the Bernie Sanders effect. Now, before you go crazy, and this is not a judgment call on Sanders, I'm just saying as it relates possibly to the market and what's happening. Sanders scored a big landslide victory in the Nevada caucus this weekend, all right? I don't think it's a coincidence that the market is down 1,000 points today. Why? Because what's Bernie stand for? How has he been framed? How is he being... In fact, he calls himself a socialist, a democratic socialist. And I saw today in some widely followed financial news outlets saying, headline, man, Bernie Sanders, the new risk factor for the market. So, people are starting to freak out. Maybe some investor, and in fact, I saw a quote from Goldman's former CEO, Lloyd Blankfein, saying, this would be a terrible, horrible, really bad thing if Sanders got elected. And you better believe all of Blankfein's friends think the same way. Now there's, before you go nuts on this, let me just say, we can test this theory because there's a bunch of primaries coming up, starting with this Saturday, the 29th, the South Carolina primary, where Biden's actually in the lead. But if Bernie wins this, and if the markets tank on next Monday, man, I think that connection is real. And then you got Super Tuesday, March 3rd, 16 states go to the polls, and we'll see what happens then. But this could be real, and let's face it, all right? We've seen plenty of market irrationality before. I mean, if you could think back to election night 2016, the Dow dropped 800 points in the futures market when the first sign of Trump beating Hillary started to come in. So we've seen it before. And don't say it can't happen, because it can. Anyway, get my report, fiscal flows. Look, the jury's not out on this, economically speaking, okay? We've seen headline trading before, and this might be a case of it. But right now, I would categorize the environment as negative for stocks. You got to be a seller on rallies. And we have to see if the Bernie Sanders effect is really something that is going to set the tone for the markets in 2020. All right, go to my website, pitbulleconomics.com. Sign up for a 30-day free trial of MMT Trader. See you tomorrow. Bye-bye.